Today we are analyzing Franklin Resources, ticker BEN. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we have a market cap of $14.9 billion, enterprise value of $19.9 billion, which means there's about $5 billion in net debt on this business, which is actually quite a significant amount because that's 25% of the overall enterprise value. It's operating in the capital markets industry. They are a publicly owned asset management holding company, provide services to individuals, institutions, pension plans, trusts, and partnerships. They have equity, fixed income, balanced, and multi-asset mutual funds. This is basically an investment company, to paraphrase. They have public equity, fixed income, alternative markets, all around the world locations. So it's interesting that the capital markets business would have so much debt on its balance sheet. I don't really know why that would be structured that way. We'll have to do a deeper dive there. Although, when I first see this return on invested capital chart, though, it looks really, really interesting because almost instantly we can see that there is not a single year in which they have had losses. They have been profitable every year for the last 20 years, which is the first key marker for me of a high-quality business. Now, there is some cyclicality in these numbers. You can see them bouncing up from 2017 to 2022, bouncing from 10%, 4%, 8%, 4%, not 8%, 5%. So there is some like numbers bouncing around, but overall these returns are really, really good. Every year from 2003 to 2017, they're hitting a 10% plus return on invested capital, which is really the metric I like to see in terms of my return on invested capital to make. And then the last 5 years, they've been below that number. So it is a little bit concerning that the recent history is not as good, but certainly they have a very strong past history in this business. Now, the margins are very interesting because the gross profit margin of 44.6% is converting into a 34% EBIT margin. That's a huge gap. I mean, that's a small gap. Normally, a 44% gross profit margin might convert into like maybe an 8 to 10% EBIT margin. So when you have a very small gap there, that means they're keeping their overhead low, that their overall operating expenses are not that high, which I really like to see in terms of they're not having to pay their employees such a significant amount of money. They're able to really turn that gross profit into a high EBIT margin. Now, what's also interesting, though, is with these high EBIT margins, you are getting low-ish returns on equity and returns on invested capital. That means your turns are relatively low. You're not actually getting a very high turnover rate. Now, again, it's an asset management company, so it's not like a manufacturer or a retailer where you could really look at turns as a major factor, but that is why you're not getting much higher returns on equity here than what we would see. I'm fine with these return on invested capital and return on equity numbers, 10%, 13%. Certainly over the previous years, you would have been much better. You can see you're hitting these metrics very well in the 2013-2016 timeframe, but you're not doing as well with it in 2018 through 2022. And so we really need to understand, why are the returns so low starting in 2018? Was there an acquisition there? What did they do that really makes the difference here with their poor returns on equity? PE of 15, again, very reasonable price. So you have a reasonably priced, high-quality business here. I like what I'm seeing from that part. The only downside that I think really leaps out to me is this growth CAGRs, 1.5% revenue growth CAGR. We can instantly see when you look at 2013, they had $8 billion in revenue. They have $8 billion in revenue today. You're basically flat on revenue even though a decade has passed. And that's really concerning. I want companies that are growing because that growth is what really drives my future return. You can get a decent future return if you're buying a PE of 15, but you really need some growth to be in there to really justify paying even a 15 price. So a little bit cheaper could justify the 1.5% revenue growth, but it's still, you want higher growth for a price like this. So even though it's an average price, above average company, you really want above average growth as well, and we're not seeing that. You have 6% asset growth, 6% free cash flow growth, and the differential here between these assets growing 5% faster than revenue actually explains why your return on invested capital has dropped from 15% down to 5% over the course of a decade. You're adding assets, you're not adding revenue, and you're not adding earnings per share, and that's what that impact would be. Now, I want to jump down to this EPS number because I think it's going to explain a little bit of it. You can clearly see the volatility in these numbers. They're relatively stable in this early period, but then you start to bounce around. $3, $1.39, $2.35, $1.59, $3.57, $2.53. So depending upon where we stop our measurement point, we get a very different look on the 10-year CAGR of results. If you go from $3.37 to $3.57, you could say, okay, they've been growing earnings over that 8 to 9 year period. But if you go from $3.37 to $2.53, you say, hey, earnings have actually gone down over the course of a decade, and that's quite poor. And now, why is this happening? Just look at operating margin. It tells the whole story. You began the decade with a 36% operating margin. You ended the decade with a 21% operating margin. Now, how does that happen? That happens because you haven't grown your revenue, but your costs have gone up. Operating profit, $2.9 billion, $1.7 billion. Gross profit, $3.5 billion, $3.3 billion. So even though your revenue is higher today, your gross profit margin, your gross profits are lower, your operating profits are lower, gross margins are lower, and operating margins are lower. When you see that negative operating leverage, it becomes very hard to get strong performance for you as a shareholder. Now, you've seen a growing dividends per share here. That means they're not able to really get the investment based out of the business that you'd like to see. You're paying out a dividend that's 40 to 50% of your overall EPS in some of those years, a lot higher even in some other years where the earnings were particularly bad. And so that means that they're running out of areas to invest in, basically, and they're unable to grow. When you're unable to grow, it just becomes harder to manage the business. It's not that it can't be done. It's not that you can't get good shareholder returns. You certainly can. I mean, you just look at these prices, reasonable returns on invested capital. The bones are there, but without that growth, it becomes harder and harder to really hit the market-beating returns. So you maybe get market returns. Market beating is going to be very difficult. And so that's where we need to go into the income statement, balance sheet, and cash flow statement to really understand if that's possible. If you're enjoying this video so far, if you're learning something, hit that like button. Would appreciate it. So let's go to the income statement. So again, cost of goods sold, has gone up a little bit. And it's going up more than your revenue. So again, that's why your gross profit margin has declined. Your SG&A has more than doubled. Okay. So your SG&A started out at 637 and it's more than doubled to 1.5 billion. And yet your gross profit had declined. And when you do that, you just destroy the economics of the business. This is a capital management business. This is an investing business. Why are your SG&A growing so fast? It's because you're paying your employees a lot. They're getting these raises. I mean, they're going up 10% a year in some years. You're spending a lot of money here, jumping from 2020 to 2021. You're starting to have some other operating expenses building in here. So the employees are taking the economics of the business of the changes in the underlying structure instead of the shareholders. And that becomes a really big concern for you because assuming you're watching this, you're interested as a shareholder, not as an employee. Now, the net income line, of course, has fallen by 50% when we compare 2013 to trailing 12 months, which is just a massive decrease. It's absolutely destructive for you as a shareholder in terms of what you're getting. And what's crazy here is your shares outstanding have declined a huge amount. You had 634 million at the beginning of the decade, 489 at the end of the decade. So you're talking about a decline of at least 20%, 25% maybe of your shares outstanding have declined, and yet your EPS is even lower. So you've bought back 25% of your shares outstanding. That's adding about 2% per year to your EPS growth rate, and yet the EPS is negative because your business has deteriorated faster than the dividend buybacks. That's not a beat on the buybacks. There's nothing wrong with these buybacks, and I don't mind the buyback plan in and of itself, but if a business is declining faster than the buybacks can save it, that's a massive concern for you as a shareholder. And for me, this is a big red flag that you've bought back this many shares and yet your net income has collapsed over the course of that time period. So balance sheet. PP&E, a little bit more than doubled, very similar to the growth in the, what did I call it? Your growth in your SG&A. So your PP&E is kind of growing in line with your SG&A. You have a lot of cash on this balance sheet, a lot of investments, very little net tangible assets. I mean, if you look at your net tangible assets and just talk about like PP&E, 1.2 billion, you're basically earning 100% return on that net tangible asset. That's a really good return on your net tangible assets, but you have a lot of goodwill here. You have $10 billion of goodwill and other intangibles. They're making acquisitions and yet the business isn't growing. I mean, look at this $7 billion in additional assets taking on in 2019 to 2020. You added $7 billion in assets. What did that do to our income statement? Okay, look, it doubled it for a year and then it collapsed. I mean, it's like, where did this go? It's like the acquisition disappeared. In 2019, you had $1 billion. And in 2022, now you have $1 billion. So like you spent as a company $7 billion on new assets and they've earned you nothing. Now, I mean, it's a short-term time period. Maybe these are really long-term paying off investments, but you'd like to see something a little bit better than that as a shareholder, especially when you think about like what that did to your debt load. I mean, look, you've grown your debt $7 billion over the last 2 years, 3 years, 2 to 3 years because of these acquisitions. You can see the big jump in those acquisition years. That debt's being used to help fund those acquisitions. You're paying interest on that debt, but it didn't give you additional earnings. So now you're paying interest on debt that didn't give you earnings and has a double whammy effect on reducing your return on invested capital and reducing your EPS. Just it's value destructive if that doesn't turn around in the long term. Cash flow statement. Not a lot of depreciation and amortization on a year-to-year basis. You can see that matching or being about what your PP&E spend is. It's gone up in the recent years because of those acquisitions. Some of the intangibles are probably being able to amortize, and that's what you'd see there. You see these big cash outlays for acquisitions, 2019, 2020, billions of dollars, additional billions in 2022. And I think you're going to also see, you see some issuance of commons. Well, no. You see this issuance of debt, of course, with those timed with those acquisitions. Why did they pay $2 billion in dividends in 2018? That doesn't make sense. I guess they had a really good year in terms of cash flow. So they're paying dividends every year, but they're paying less in dividends at the end of the decade than they did at the beginning of the decade. That's not great. They're buying back stock every year. And they're also issuing a lot of shares at stock-based compensation. I mean, really a lot. I mean, $200 million in stock-based compensation when you're earning $1 billion in earnings. I mean, you're just paying out like 20% of your earnings in stock-based compensation. Now, asset management is definitely an employee-focused business. It's a service business. The employees are driving a lot of the value. It understand why you might give them stock-based compensation. But you're having to do these buybacks just to offset that compensation. And it means the underlying economics are a little worse than you might otherwise think because of like the accounting shenanigans that you get when you throw in such a big amount of stock-based compensation on a business of this size. Overall, I'm going to avoid Franklin Resources. I think you have the underlying high-quality business here that has found a way to not grow. And when the business like this is not growing and yet it's raising the pay for its employees and it's raising its overhead over time, it's going to destroy the economics of the business over time. And that's what we've seen. You can clearly see they've deteriorated from a 22% return on invested capital down to 5% over the course of a 15-year period. I don't want to see what the next 15 years look like because of that deterioration. If they turn it around, you're going to do very well. But if it stays the same or gets worse, I don't think shareholders are going to be well off by owning Franklin Resources. So for me, I'm avoiding it. It won't be going on my watch list. If you learned something from this video, please hit that like button. Don't forget to subscribe. That's a great way so that YouTube can let you know when my next videos come out. We're going through the entire S&P 500. And if you want to see the ones that are my favorite, watch list, playlist right up here. These are the stocks that have made my watch list. I hope you'll check out those. There's some really good companies in there and they're worth watching as well. Now, if you like the software that I'm using, quickfs.net, you can sign up for a free account through my affiliate link. It's the first link in the description below. So consider going to quickfs.net through that link. Thank you for listening. And until next time, stop paying fees, start building wealth.